Well, hello. Let me just check my audio is working. So hi everyone. Hi Sarath. Thank you for your welcome. Good evening to you. I hope you're well and healthy as well. Zishan, hello. Hi Dion. Hi JJ. Stephen. Mad Metal 75, hello. Very good. Hi Bobby. And Thomas, hello. Thank you for joining today. And Matthew from York. And Rachel, hello. Raphael. Kay from London, great. Sanjay, hello. Member of the home team. Jenny, hello. Right. So, I guess we can get started. It's 7 o'clock now. So, thank you for joining. And yeah, don't forget that if you like this, other people will realize that we're streaming. So it will certainly help us if you like the channel. And if you subscribe, obviously, you'll get access to our future content. So please do like it and please do subscribe. So I thought I'd just start off before we kind of kick off with the questions, just talk about some of the stuff that's been happening recently and how there's this even bigger disconnect now between what's going on in markets and what's going on with the economy, but also with the social unrest. I think it's kind of shocking what's happening on the streets of America, and the huge divide between that and the state of calm that's in equity markets at the moment. It is very striking. And it's one of the things that there's been a lot of discussion about in our Slack channel in Pensioncraft. And it seems like you can almost kind of divide our group into two, the community into two groups of people. Some who maybe don't understand the rally but are willing to buy into it. And then some who are more sanguine about their faith in the economic downturn pushing equity downwards. So I'd say probably it's 50-50 in the community, but it's very difficult to see why the bailout packages have been so effective when we're getting such absolutely abysmal data. I think people just assume that either they're kind of missing out on a rally, so they don't have a choice as to whether they buy into the market, or they really do believe that we're going to have a very quick recovery and pretty much go back to life as normal once the lockdowns ease. So I think personally that, I'm a bit more concerned, I think, about the economy. And personally, I do think that we're going to see another sell-off before we do see markets rally again. So that's why I'm staying cautious. I haven't changed my asset allocation, which is 20% equity and 80% government bonds. So I've got UK government bonds, US government bonds hedged into sterling. So I'm still very cautious, and I haven't participated really in this rally. But I also had limited downside because that was my position going into this before the sell-off. So really for me, I think what I have to see is some kind of sign that we're going to see earnings growth improve before I can really buy into the market with any degree of confidence. And I know that might leave me, with kind of very poor returns if markets do rally without any sign of earnings picking up. But I'd kind of be okay with that. I don't mind missing out on the rally because I don't believe in it. So anyway, that's kind of my personal portfolio. But I don't make forecasts. That's really not what I do. What I try to provide is financial education so that people can make up their own minds. And I love to see the debate in pension craft between members of the community who each have their own opinion, and many of those opinions are different from mine, which I think is great. All I can do is really provide a bit of background and explain valuation if people are interested, and explain some of the dynamics of markets, particularly credit markets, bond markets, which people don't usually know much about. So, yeah, I think it's been an interesting debate this week. Personally, on pension craft, it's been very interesting on Slack. In terms of markets, today, I don't know if you watched it, but the ECB just announced that it's going to boost its bond buying program by 600 billion euros. So that's a very substantial increase in the size of its bond buying. And that'll take their total bond purchases to, the total size of its asset portfolio will potentially go up to 4 trillion euros, which is about a third of Eurozone GDP. So that's certainly a very significant increase in their stimulus program. If they hadn't done that, they may have maxed out their purchases by October. So it's interesting that they did that. Also interesting that Christine Lagarde, she wore her blue scarf for the press conference. If you listen to Katie Martin, she always used to joke about Draghi's tie, what colour it was, and then trying to figure out what secret message he was sending to markets according to the colour of the tie. Well, this meeting that we just had, Christine had a quite jaunty aquamarine colour. I'm not sure what the significance of that is. And if we look at, there was an article in the FT as well, which is kind of interesting. Let me just share this with you. If I switch to OBS and Chrome, back to OBS. Yes. So hopefully you should be able to see my screen. This is a story about a very famous asset allocator called Jeremy Grantham, who's made some great calls in the past. And he thinks that stock markets are lost in one-sided optimism. So this is the debate that we've been having in pension craft. He's very clearly coming down on the side of fundamentals matter more. And he's just reduced his equity allocation from 55% to just 25%. So that's roughly what he had during the global financial crisis, which he also did a fairly good job of navigating through. So he's got various reasons for that, but he thinks that the central bank stimulus efforts have temporarily overwhelmed economic realities, but he doesn't think that's going to continue. So he thinks that markets have simply come unhinged from the fundamental truths of the economy. And he says that if anything, the recent market rally has made him more convinced that he's right and that things are going to end badly. And he says if it does end badly, the history books are going to be very unkind to the bulls. So the difficulty which many institutional investors face is that if we're going to get a rally, they have to buy into it, because otherwise they'll lag their benchmarks and they'll lose their job if they're lagging the benchmark. So that's why many of the institutional investors, if it goes on for a long period of time, this rally, then they'll be forced to buy into the rally, and even if they don't believe it's justified. So I think really if it does last for a very long time, then we will have institutional money, and that's where most of the money is, I think that'll kind of chase the rally too, which will tend to make it self-sustaining. But it really depends if there are more people like Grantham who just say, this is crazy. The king is in the altogether. I'm not going to buy into this rally. Okay, so so let's go back to the stream. Oh, and we've got a super chat. Yes, I should have said, if you do super chat, we will answer your question ahead of the others. So, oh yeah, here we go. So Anton Belev says, I want to ask you, if you receive big paycheck right now, 50k, how would you manage it to make the most of the current climate? I mean, personally, I think most people really, you need to find the asset allocation you're happy with and stick with it. So if I was managing on behalf of someone else, then I'd kind of ask them what that allocation was, and I'd invest in that portfolio split. But it really depends on how long their investment horizon is. So if you're investing for more than 10 years, then there's very little reason to hang back from the market and not put money into the market right now. So I'd probably say, personally, what I'm doing is, as I say, 20% equity, 80% bonds with my money. But it really depends on what that person's investment goals were. Also their risk appetite, their investment horizon. All of those would affect what kind of asset allocation would be suitable for them. So it's very hard to know what that would be. So I'm not sure. I'm not sure that I do exactly the same as my portfolio. I almost certainly wouldn't, because their investment horizon would be different from mine. That's why I always say, don't do what I do. Always try and think for yourself. I'll show you how markets work, how valuation works, but really it depends on your personal circumstances, what you do with your money. So yeah, that's what I'd say. It really depends on investment horizon and your risk appetite. But if you are a long-term investor, so say somebody was like 30 years old, in that case, 100% equity wouldn't be unreasonable because, in 30 years' time, it's very unlikely that markets will even have any kind of memory of this crisis. And returns over that period of time will almost certainly be positive for equity markets, no matter how bad it gets. As long as you have a diversified portfolio and it's global, it's very unlikely that you'd lose money over 30 years. Okay, so I hope that partially explained what I do, Anton. Okay, so let's go. I'll start with Anton's comment. So the UK is about 4% of the world markets. This is SAC Media 1. And then Raf Didi says, would you put any money into oil? Well, I can't, because I'm with Vanguard. If you're talking about me personally, Vanguard doesn't offer in the UK any commodity funds at all. No gold, no oil, no softs, no industrial metals, nothing. So I couldn't, even if I wanted to. But would I, if I could? Probably not, because I think the factors which have driven oil down are not going to go away quickly. Also, oil is almost unpredictable because it is very much politically driven, and often things like a declaration of war or any kind of political instability in the Middle East can push up the value of oil, and that's fundamentally unpredictable. I guess you could say because of the lockdowns, demand is low, and ultimately it's going to improve again, but really it's a question of also politics within the oil producing countries as to whether supply is increased or cut. So it's very hard to call oil. Personally, I wouldn't really try and dabble in it. It's not really my thing. I'd much rather buy much more boring assets, so equity bonds that I'm much more I'm kind of happy with, more familiar with. Commodities, I think, are just inherently unpredictable. So I wouldn't, no.
Richard Watts, are you still not convinced by Bitcoin paid a pound?
Oh, Richard Watts. Am I still unconvinced by Bitcoin? No, I'm still not convinced by Bitcoin. I still don't invest in crypto because I don't understand it. And I don't think it has a fundamental value because it doesn't generate an income. And I never invest in assets which don't generate an income because it's very hard to know what they're worth. And their worth could be zero. So you could say the same about gold, for example. And I don't really like gold because it has no fundamental value. It's just worth whatever people are willing to pay for it. And that is not something I'm comfortable with. I prefer something where I can say, these are the cash flows it generates if you own it. So that's my fundamental gripe with Bitcoin and gold as well. I don't like either, to be honest. But if I did have to choose a hedge, I think I'd probably go for gold because historically it's just been a much better hedge when equity markets sell off. So when we saw equity markets sell off in March, Bitcoin also sold off. So it very clearly revealed itself to be a risky asset rather than a safe haven asset. So from a hedging perspective, I don't like it. As a store of value, I don't like it. So no, personally, I don't invest in or kind of speculate in crypto, I should say. I'm sorry if that's not the answer you wanted, Richard, but it's best to be honest. Okay, so back down the list. Okay. Could you briefly explain the fundamentals of why a stock market index can rise indefinitely? This is Norman Green. Interesting question, that one. People always say that the upside on stock is unlimited. And there's a good reason for that, which is that the earnings generated by companies are also unlimited. Just as GDP growth is unlimited. Whereas for fixed income, say you lend money to the US government for a space of 3 years, right? You know you're going to get your $100 back after 3 years with some interest. So the upside is capped, it's limited. Whereas if you buy a stock, let's say Walmart, effectively you're buying a stream of cash flows that could go on forever. I mean, most companies don't exist forever, but you pretty much, they can exist for a century or more before they're taken over or they're merged with another company. And that means that what you're buying is a perpetual instrument, a perpetual stream of cash flows, which will be paid to you forever. And that's why, as long as they continue growing those profits year by year, which some companies have been very successful at doing, then the upside is unlimited. So that's why if you buy a stock, it can carry on growing forever. I mean, you could say that the Earth is a finite resource and that limits the amount of upside, which is true, but we may not always be stuck on the Earth. So if we colonize Mars, we colonize the asteroid belt and ultimately the stars, then ultimately the resources in the universe are unlimited. So yeah, maybe that's thinking too far ahead, but there is unlimited upside for equity. So that's why the prices can continue to go up forever. Oh yes. So if you do want to join our community, remember you can do that for $10 and then you can join us on Slack and we can have these discussions interactively and you can speak to the other members of the community. And I'm really impressed by the quality of the discourse. There are some really very interesting comments being thrown around this week and previously as well. So it's just $10 a month. There's a link in the description of the video. Just go to patreon.com/pensioncraft and you can sign up. It's $10 a month and you can join us on our Sunday evening call. which happens every 2 weeks. And what we're going to do from now on is we have a kind of library of videos where you suggest a video topic and then I record a video that describes the answer to that question. And we found that that's kind of a nice way to do it because it's going to be nicely indexed with individual topics, and that way over time we're going to build up a kind of database of questions and answers. So you get access to all of that as a member of the community. And you can talk to me pretty much anytime you like on Slack, which some people seem to find valuable. So Deepak says, I hope you and your family are safe. I have 60% cash, which I'll deploy if another crash happens. Where can I park money for the meantime? Now, if you do want to keep your money safe, well, cash isn't necessarily a bad option because with interest rates so low on bonds, I don't know where you're based, Deepak. If you're based in India, I know you can get a much better return on bonds than you would for cash. But if you're in developed markets, so if it would be somewhere like the US or the UK, then really cash and short-term bonds offer very similar returns now. So cash is actually quite a good option as a store of value and as a very safe store of value. Alternatively, you could put it into something like a money market fund, which will invest in things which are very short term. So very short dated treasuries, so T-bills, which have less than a year to maturity, or even shorter, maybe 3 or 4 months to maturity. Commercial paper, which is very high quality credit, where a company wants to raise short-term money for, say, 3 months, and then it issues a short-term commercial paper, and that way they can borrow in the market very cheaply if they're if they have a high credit rating. So those are the kind of investments that would go into a money market fund. There are also things like term deposits and certificates of deposit, which are, again, IOUs from banks, but very high credit quality and very low risk. So the idea here is you've got very short duration, so very little interest rate risk, very little credit risk, and very little return. So money market funds are the traditional place to park your money. And the primary goal of a money market fund is not to break the buck. If you put $1 into it, it must never be worth less than that dollar. And in 2008, of course, they did do that. They did break the buck, which was terrible. So the Fed has been very careful to ensure that money market funds don't do that this time around. And they've got a specific credit vehicle to ensure that doesn't happen. So people don't lose faith in money market funds as a safe store of value. Okay, I hope that answers your question. Oh yes, please like the stream, and please do subscribe because you're going to be able to see our videos in future. It's probably worth mentioning, next video I'm working on is on the UK housing market. So that's going to be released to the Patreon supporters either tonight if I finish editing it, which is looking decreasingly likely, or tomorrow, and then it'll be on YouTube after that, after they've had a chance to preview it. Okay. Any comments of buckets in your portfolio? Well, I guess what you're talking about there is the bucket approach to investing, where you put some cash aside in case you have need of emergency money, and then you have a longer term bucket for your investments. And what happens is your short-term bucket protects your long-term bucket. So you promise you'll never touch that long-term money for decades. And having the short-term liquidity bucket in very safe assets means that you don't have to touch that money, even in an emergency. So that's, personally, I've got fairly large cash savings, which is a remnant of the time I used to work for an investment bank, where it's always a good idea to have lots of savings because job security isn't great. But yeah, at the moment I've still got quite big cash savings, and that's I think that's generally a good idea. Of course, if you have too much in cash, it's going to erode the long-term returns of your portfolio. That's just something to bear in mind. So if you do build up too much of a buffer, it can be a drag on your returns. So for some people, it doesn't make sense to have too big a buffer. But 6 months of your living expenses should be reasonable. Depends on how long you think it would take to get a job. If you did lose your job, or if you became ill, would it be difficult to start to earn again? So let's go on. What do you think of the idea proposal that public debt will be monetized by the central bank? Oh dear, it scrolled up. Monetized by the central bank. Oh dear, I lost it. Of course, that has happened already. So the Bank of England, for example, has said that it would monetize UK debt, for example. Okay, well, I have completely lost that question. Here we go. Public debt will be monetized by the central bank, buying it and renewing the bonds indefinitely. Okay, what's pretty clear is that many governments have run up a lot of debt bailing out people during this shutdown. Now, if they have to pay that back and they want to shrink the size of the debt to GDP ratio, the way to do that is to have growth, GDP growth, which is greater than the average interest rate you pay on your debt. Now, if growth is 3%, 4% for a developed market, then the central bank, you bet, will keep interest rates low such that the country can grow its way out of a high debt to GDP ratio. It would be quite damaging to the economy if the central bank started to raise interest rates while it has a huge debt load, because effectively it would be derailing its own country's debt to GDP ratio, and it would run counter to the central reason why we have central banks, which is to create financial stability. So I think that central banks will be forced to keep rates low until they've managed to shrink the debt to GDP ratios at least a little bit. At least I don't think they'll increase them massively, the interest rates, while the debt to GDP remains very high. Is it not normal? So Ruchard says, is it not normal that valuations go up due to the amount of money that's been printed? More money chasing fewer stocks. It's certainly true that central banks have managed to inflate asset prices. So that one thing that QE has done very effectively is increase the cost of bonds and the cost of equity. So the price, equity prices have been inflated, and so have government bond prices by QE. But would it directly increase valuations? That really depends on what happens to earnings. So if earnings go up in line with prices, well, that's not such a bad thing, right? Because it means that there's a reason why equity prices have gone up. If equity prices go up without earnings increasing, that is an issue. And that's what we were seeing in 2019 before this all kicked off. We had 4 successive quarters when the S&P 500 had almost no earnings growth, but prices increased. So it really depends on what's happening with earnings, I think. But just printing more money won't necessarily increase asset prices. And it took a long time for the Fed, for example, to increase equity prices in 2008, 2009. There were lots of relief programs announced before markets turned around, for example. So, interesting question. Pay off a mortgage or invest? I'm 40 years old with a small ISA and 20 years mortgage left. Now, I think the important thing to understand here is the relative benefits of the investment and the amount you're paying on your mortgage. So at the moment, the mortgage rates are very low, which means that in order to grow your assets such that it's more than worthwhile to invest, better than paying off your mortgage, isn't that difficult. The bar is very low. So you're more likely to have better returns on your investments, on your equity investments, for example, than you are not having to pay the very small interest payments on your mortgage. If mortgage rates were more like 5% or something crazy like it used to be like 12% or 20%, then the case for paying off your mortgage is much stronger. But when interest rates are low and likely to stay low, let's be honest, for some time to come, then the benefits of paying off your mortgage are less obvious. Now, psychologically, you may want to pay off your mortgage just to be free of debt, and then you can invest. Or you could do a combination of both, and that's what most people I know tend to do. They pay off some mortgage and they also invest. Of course, it's much lower risk to pay off your mortgage than to invest, because you don't have that huge volatility to contend with, which you do with an investment. So at the moment, I'd say the balance seems to be more towards investment, but really it depends on what you psychologically would prefer. I think a lot of people like the comfort of having no mortgage. Wouldn't it be great to live in a house mortgage free? Martin Newman says Vanguard itself has predicted equity returns of 6 to 8.5% per annum for a UK-based investor over the next 10 years. True, pretty low. It was pretty low before, so I think in 2019 they're expecting something like 5% for equity. Now they're forecasting higher returns because equity markets sold off. Now that equity markets have rallied again, I bet the next forecast is going to be even lower because valuations are higher than they were before the equity sell-off in March. So really it depends on what valuations are, which Vanguard says itself in their long-term outlook, their 10-year outlook. Here we go. So JJ, thank you JJ, says, as a Patreon subscriber, thank you, I'd really recommend signing up for the weekly call. It's more private and you can get questions answered every time, pretty much. Yep, true. It's a much smaller pool of people and we kind of know each other. So you do get your answer it's much more likely you're going to get answered on there than on here. That's true. So thank you for asking that, JJ, and thank you for the positive feedback. Stephen says, what's an ideal level of UK bias in an equity portfolio? Well, the UK is about 5% of global equity markets. So let's have a quick look at that. Let me just share my desktop. And if you just Google MSCI ACWI PDF, you can get the MSCI All Country World Index is global equity markets for developed markets and emerging markets. So 23 developed, 26 emerging, with over 3,000 stocks in it. It covers about 85% of all the stocks you can buy in the world. And if you look at the UK only makes up about 4% of global equity. So if you have more than 4%, effectively what you're saying is that the UK will outperform the rest of the world. So that's your neutral position, would be 4%. If you're a US investor, your home market makes up 58% of global equity markets. So for them, a neutral position, or for us actually in the UK, a neutral position would be 58% US. Now it's interesting, there was a chat today on Slack where they were saying that's not diversified. If you've got 58% of the investments in the US, how can that be diversified? But of course it is, because market cap weighting just represents the liquidity in markets. And that's why we do market cap weighting, because the most liquid stocks are the largest stocks. And if 58% of the stocks in the world are in the US, that's just the kind of most liquid investment you can make. I guess the answer to your question is 4%.
Asset allocation.
Of course.
Yes.
Yes. Okay. A voice is telling me that, we have an asset allocation course, which is kind of like the crown jewels in terms of our courses. It takes a lot of what I learned as a strategist at an investment bank, as an asset allocation strategist, and tries to teach retail investors, that's normal investors like you and me, how to invest more like a professional. So you have a much more structured approach to risk, but also an understanding of cognitive biases, which stop you hopefully from doing silly things. But also some of the strategies, typical asset allocation strategies, which have worked well in the past, and how to construct those, and also how to calculate risk and control risk. Because I think that's what really sets apart a professional investor from a kind of mom and pop investor who's just basically taught themselves. So you'll find that on our description links for this video if you do consider doing the asset allocation course. Plus you get 3 hours with me one-to-one like this, where you can ask any question you like, as long as it's to do with investment, right? Personal questions? No, I don't do that. Okay. Right. So back to the questions. Right, how are we doing? So we're 35 minutes in, we've got 25 minutes to go. Do you invest in individual stocks? If so, what method do you use to determine fair value? I don't, Pete McLennan. I don't do that. I don't invest in single stocks. I just don't have the time to track hundreds of stocks and to read their annual reports. I just couldn't do that. I couldn't manage it. Also, I don't think I could outperform an index, because I don't think most active managers can do that. And I'm very modest about my own ability to outperform markets. So I wouldn't even try to outperform markets by stock picking, because I think it's very difficult to do. And even people whose job it is to do that, who do it 24 hours a day, who have big research teams and who have Bloomberg, I wish I had a Bloomberg terminal again, or who have access to research from investment banks, even they can't outperform the index 80% of the time. So 80% of them don't manage it. So I don't think I could. So I never invest in individual stocks personally, because I kind of have internalized what the SPIVA report says, the S&P index versus active report from S&P, which is that it's very, very difficult to outperform a benchmark. So no, I don't. Floris Vermeer says, good Dutch name, when a fund is listed in US dollars, while the underlying value is assets in yet another currencies, such as stock in China or gold, should the value of the fund in Euro GBP remain the same when the dollar falls? I guess when it's so, for example, this happens a lot for things like emerging market funds. Or let's take the example of gold, right? So let's say you're buying gold in US dollars. Because gold is priced in dollars, because that's just the way it works, that means that if sterling weakens versus the dollar, it actually increases the value of your dollar gold if sterling weakens. If sterling strengthens versus the US dollar, then it reduces the price of gold in sterling. So yes, you are exposed to your domestic versus US dollar currency fluctuations, if that's the case. So you are taking the currency risk. For many funds, you can hedge that. So for a few basis points, usually, it's very cheap. You can get a hedged version of a fund, particularly for fixed income funds, where you're not taking the currency risk. And if you don't have a view about your currency versus the dollar, it's usually the dollar, then hedging kind of makes sense. If you think your currency is going to weaken versus the dollar, then hedging doesn't make sense if you have that view. And if you think your currency is going to strengthen versus the dollar, then hedging does make sense because that'll remove that risk of your domestic currency strengthening. So yes, you are taking a currency risk there. Jonathan Ball says, I enjoy your videos very much. Thank you for educating the ignorant masses. I'm not sure that that's true, actually. I'm very impressed by the level of knowledge I see often. One question, given the illogical run-up in equity prices, do government bonds look attractive again? I wouldn't go so far as to say they're attractive. I'd say that they still work as a hedge. That's the important thing. So if equity markets do sell off, I think that the government bond markets will still work as a hedge. But the income they give you is very likely to be negative once you subtract the rate of inflation. So the real rate that they have for government bonds is pretty much negative across a large proportion of the yield curve for the US dollar, for sterling, and definitely in the euro. So that certainly makes them less attractive. But if you are going to take some duration risk, in other words, if you go further out on the curve, you can get not so negative returns, hardly a sales pitch, but you will get that rallying behavior when equity markets sell off, which you don't get with cash. But attractive? Probably not. So yeah, I should say, please do press like, because other people will then see that you've liked it, and it certainly helps us at PensionCraft. And if you do like this kind of interaction, then why not join our community? You'll be part of a much smaller call, so much more likely that you'll get your question answered. And it costs $10 a month, and you get to join us on Slack, and we can have chats about investment or even other topics we sometimes discuss on Slack. Oh yes, and if you want a one-to-one with me for individual coaching, I offer a power hour for £80 an hour, and that's one-to-one. And remember, I don't provide advice, I just provide education. But many people find it useful to discuss investment, about individual assets or individual funds, and what they actually mean and what they actually do as part of your portfolio. Because I think building a portfolio is very much like painting. If you've got a good feel for colour, then you will do much better in terms of painting. And similarly, if you understand the individual assets, ultimately what you develop is a sense of taste for how to combine those assets into a portfolio that expresses your belief about what's happening in the world. So that's, I think, what I can offer in those one-to-one sessions with the Power Hours. Anyway, there'll be a link to the Power Hours in the description if you do want to sign up for that. And I'd love to have a chat with you. I always greatly enjoy the Power Hours. I think it's great having that one-to-one connection with people, particularly the second or third time we meet, because you tend to get to know people quite well, and it's often quite valuable for me as well, because I can see what people's concerns are about markets. But apparently it's valuable for you too. Imagine that. Okay, so Zishan Raman says, you mentioned that you have changed your portfolio as 80-20 bonds equity. Have you done that to your long-term investments such as pension pot? Well, my pension pot at the moment on Vanguard is £125. So that is invested, oddly enough, in Life Strategy 20. So it is, yes, 20% equity, 80% bonds. But my pension pot, I have legacy pension pots with companies I've worked with in the past. And to be honest, I'm not sure what they're invested in. I know I should, but I don't. And I don't have much control over it, which is why I don't like those legacy pension pots. Right. So let's scoot down. Let's go to the more recent comments at the bottom here. Paul Molyneux says, Ramin, do you provide a personal financial advice service? No, I don't provide any financial advice at all. I just provide financial education, which is this, right? But the difference, I think, is that I don't tell you what to do. I don't promote products. I don't promote funds or platforms. What I do is I teach you how to make better investments yourself. So I don't provide advice. You can probably tell because at the beginning of every video I say, this is not advice. Okay. They say China is the future. What's the best ETF to track all of China? I did a whole video about this actually, where I talked about A shares, H shares, B shares, and so on. So I would suggest that you just go and find the video, how to invest in China, where I talk about all of the details of that. That's probably best. Oh no, there we go. Paddy Megan says, did you see Terry Smith's Sky News interview on Sky today, urging income hunters to focus on growth stocks funds rather than income stocks funds? Any views? Yeah. I completely agree with Terry Smith, because if companies are cutting their dividends, then, which is what they're doing, many of them, because they're worried about running out of cash as their revenue falls during the lockdown. Many companies have cut their dividends. I think it's about half of the FTSE 100 now has done that to some extent. If that's the case, then the really important thing is your total return, which is a combination of income plus capital gain. Now, if the income's gone, then you're just going to rely more on capital gain. Where do you get the greatest capital gain? It's growth stocks. But of course, you have to bear in mind that Terry Smith is a growth investor. So he is, as we say as we'd say at the investment bank, he's talking up his own book. He's trying to get you to invest in his strategy, if not his fund. But I agree with him. I think, at the moment, if you're going for income investing, it's going to be very difficult to find companies which carry on paying their dividend through this crisis. Yeah, interesting point. Thank you for that, Paddy. Gary Nutter says, is it just pensions? Can it be about stocks too? For instance, what do you think about investing in Lloyd's? I guess you're talking about underwriting, insurance underwriting. Well, it's a very high risk thing to do, because if you become a Lloyd's name, then you could potentially be liable for a very large payout if the thing you've underwritten requires it. So there's a huge difference between being a Lloyd's name and being an equity investor. For starters, I think the risk and reward is much more favourable, probably, for equity, and there's greater liquidity because you can get out of a position very easily, whereas if you've underwritten something, you may not be able to get somebody else to step into that credit exposure in your stead. So yeah, I just think it's a lot better, a lot easier, and a lot more liquid to use equity and bonds and maybe commodities to invest. Okay, Robertus says, inflation-linked bonds versus regular bonds during this environment? Which is better? And what happens to inflation bonds if there's a sell-off in the stock markets? Well, to some extent, inflation-linked bonds are government bonds usually. You can get corporate bonds which are inflation-linked, but they're more unusual. So let's assume they're government bonds. They do behave like government bonds. In the UK, they tend to have very long duration, which means that they would rally if equity markets sell off, because the yield curve will move down and their price will increase, because there's an inverse relationship between yield and price. So in that sense, they're similar to government bonds. If you do think that inflation is going to become an issue, so it's going to increase significantly, then you would go for inflation-linked bonds, because they really are the only real hedge for inflation. Gold is a very poor inflation hedge. Equity also is a very poor inflation hedge once you get above about 5% inflation. So really, the only reason you do that is for the inflation hedge, unless you're speculating on inflation elsewhere. But usually you'd go for your own domestic inflation-linked bonds because you'd be hedging against inflation in your own country.
10 more minutes, like.
Oh, yes. So we've got 10 minutes to go. Please do like this stream. I know that the number of people tends to pick up over time. We've got 375 viewers. So, yeah, please do like, and it would be great if you do that. And then other people will know that we're doing this. But also it'll help us in the future with the channel. Do you invest in VIX? Nephilion says, or other volatility products, as you've written a book on the topic? Well, tragically, no, because I can't, because I've got Vanguard as my platform, and they only allow you to invest in things like bonds and equity. They don't even have high yield credit, and they don't have any commodities. So I can't invest in it. Would I invest in it if I could? Maybe. I might go for something like one of these dynamic VIX products as a percentage of my portfolio, particularly at the moment, as a hedge for an equity market sell-off. In fact, they're more reliable. These dynamic VIX products are more reliable than treasuries as an equity hedge, because volatility always goes up when equity markets sell off. Whereas treasury markets don't always act as a very good hedge. Usually they do, but not always. So no, I don't, unfortunately. Thomas says, do you think we'll get... Thank you again, Thomas, for signing up for PensionCraft, and welcome. Do you think we'll get a deflation in Q4 2020 followed by hyperinflation to balance the market? Okay, hyperinflation I think is unlikely. Deflation, we're really not that far away from it right now. So if you look at the Eurozone inflation, Christine Lagarde was talking about it today, they're pretty much on the cusp of deflation right now. And with oil prices falling so sharply, you know, we may see deflation across much of developed markets if it remains low, the price of oil. And if demand remains weak, we could see deflation more broadly. So I think deflation is pretty much a done deal, or quite likely. Also, if you look at the Fed's inflation deflation model, which I talked about in my inflation versus deflation video, there's a link to it in the description of that video. The model is now forecasting that there's something like a 75% chance of deflation in the US. But to get hyperinflation, I think we just don't have the velocity of money that we'd need in order to achieve that. Plus, you know, we had this huge QE program for a very long period of time with almost no inflation. I mean, that's what characterized the last decade, is a lack of inflation, despite the huge efforts of central banks to try and create it. And it wasn't just one central bank, they were all doing it. The Bank of Japan, the ECB and the Fed and the Bank of England. And none of them really convincingly achieved that until quite recently. So I think hyperinflation is fairly unlikely unless something fundamentally changes, unless the velocity of money increases, unless everybody suddenly goes out on a crazy spending binge, which is frankly unlikely. I think people are likely after this event to be cautious and precautionary and to save more rather than spend. But we'll just have to see how the psychology pans out, because ultimately this is driven by human behavior, which is unpredictable. But I think hyperinflation unlikely, inflation perhaps, but I think what is inflationary is if we change the supply chains away from countries where it's advantageous to move your production to make it cheaper. So if you start moving all of your supply chains into the domestic market, usually for developed markets, that's going to be more expensive. And so that will be inflationary. So that potentially could be one source of inflation. But demographics tends to be disinflationary. As we get older, we consume less, and we have aging societies across much of the world at the moment. So there are competing forces there, but hyperinflation, I don't think so. Elio 1862 says funds like Lindsell and Fundsmith seem to have weathered the financial storm better. Better than what, I wonder? Yeah, I mean, if you look at the video I did recently about strategies, the best investment strategy for 2020, I did talk about passive funds and active funds over the last decade. Turns out that if you'd just gone for QQQ, which costs you 10 basis points, 0.1%, you'd have outperformed Terry Smith's Fundsmith fund. You'd have outperformed the vast majority of active funds with about 1/10 of Terry's fee. So, you could actually outperform just by being exposed to passive tech funds in the US or growth funds in the US or biotech in the US retrospectively. That would have done better than Terry at a much lower cost. So I think a large part of the UK fund outperformance was generated by the sterling weakening versus the US dollar. So if you go for the UK version of QQQ, which has the ticker EQQQ, that did a lot better than the US version because of sterling weakening. So I would recommend you have a look at that video before you say that Lindsell and Fundsmith have outperformed better. And of course, QQQ is above where it started before the sell-off now. So, yeah, I think I'd rather track those cheaply than pay 10 times as much for those active funds. How are we doing for time? Oh, we're almost there. We're almost at 7. We're almost at 8 o'clock. So just the last few questions now. Hi, Ramin, Jonathan Ball. What do you think of investing personalities like Jim Cramer? Okay. Jim Cramer's funny. I like him. I find his voice strangely annoying. I don't know why. I just find it quite whiny. But as a character, he's hilarious. I just love watching him. I love the showmanship, I think. Plus, he says some really interesting things. He's never boring. He's always interesting in terms of his views. So that's why I like him. Would I invest on the basis of what he says? Probably not. He does a lot of single stock stuff, which I would never do. But do I like him? Yeah, I like him. I think he's very entertaining. Are we about to see a bond bubble? This is Tripty Sexaria. Personally, I don't think we're going to pop any bubbles in the bond space because we're not going to see interest rates increasing rapidly because central banks will remain very accommodative. They'll keep rates low for a long period of time now because they're trying to make sure that economies survive this crisis period. So it's unlikely we're going to see rates increase rapidly. What could go wrong is higher inflation, but as I said, I don't think that's an issue at the moment. But if it was, then yeah, that would be a problem, and that could make a lot of long duration bonds in particular sell off quite significantly. But I don't see any immediate problem with bonds unless we get a huge equity rally, which we've kind of had already, and bonds have actually weathered it fairly well. So I guess that's what you're asking, whether it was about to pop. I don't think the bubble's about to pop. Do you share, so I can't pronounce, I'm afraid, your description of your name, but do you share Andrew Bailey's confidence that the economy should bounce back fairly quickly? No, in a word. I think it could take some time for the economy to recover. If you look at forecasts from institutions such as NISA, they show that after the 2008 crisis, it took 7 years for unemployment in the UK to fall from 8%, where it peaked in 2011, to 4%, which is where we reached in 2018. So it can take a long time once you make people unemployed to get them back into work. And they call that hysteresis. That's the scarring of the economy. So I think it could take longer. Okay. Adam Wright has a great comment here. What do you mean Crane's voice is annoying? Yeah, great comment. His voice is odd. Yes. And how are we doing? We're about there. So one more question. Who will it be? Okay, so Ed says, would you expect owning an ETF or owning the stocks in that ETF in the same proportions would be a better investment in the long run? I guess it kind of depends partly on the fees that you pay for the structure. So if your ETF is cheap, then as long as it doesn't add a huge overhead, then it could be cheaper to own the ETF, because the thing is, an ETF, if it's passive, will track a benchmark, and the benchmark's not static. People call it a passive fund, but it's anything but, because if you speak to someone who owns or manages one of these passive funds, they're busy all the time because the index constituents are changing, the weights are changing day to day, so they have to ensure that they maintain the weights in line with the benchmark, and that's not easy, and it can incur big trading costs if you're a small investor. So it's almost certain that you'll underperform because of trading fees, the main index, and you just wouldn't be able to sleep at night. So, I think owning the individual stocks isn't as easy as you might think. So thank you all for joining us. As I say, we have a community, Pensioncraft. You can join us for just $10 a month, and you can have these questions answered much more with greater likelihood because there are less of us on the call. And if you do a power hour with me, we can have one-to-one sessions where you can have all of your questions asked on a personal basis. And we have an asset allocation course where you can learn in your own time about how to invest. And thank you very much for your time. Thank you for these great questions, as always.
Market roundup.
Yes, and we also have a free market roundup, which is available in the description. You'll find descriptions of all of these in the description of this video, and you'll find the links there too. And thank you all for your time, and have a great week, and hopefully we'll see you as part of the community if you're not already. Take care, everyone. Bye-bye.